login. Uh, a very good evening to all of you, and a warm welcome to the fourth day of the 10th edition of this Global Money Week that is being celebrated in India with SEBI as the national coordinator. And today we are on the fourth day. As you know, we have arranged a series of national level webinars involving all the four sector regulators. We had on Monday and Tuesday Reserve Bank of India and the SEBI who talked to us about the banking and the securities markets. Today is the third seminar in the series, which is related to the pension system in India. And we know we all have to retire one day, and retirement date is in many of the corporations and is immutable. So you know right from the day you join your service that when you are retiring, and otherwise also the retirement is now has got a new definition. Many describe the new retirement as freedom, to have the freedom to do what you want to do and when you want to do. And you can do that only when you have the financial freedom. And the financial freedom you can have at the golden innings of retirement, you can have provided you care and you prepare. That means you adequately save and appropriately invest. So that's how the retirement. And if you want to have a post-retired life, how much money to keep aside so that you can maintain your same standard of living for the next so many years that you live without working. And to talk about all this important uh, planning, how to plan smartly for retirement, we have with us none other than the Chief General Manager of the Pension Fund Regulatory Development Authority, and he is the Chief General Manager heading currently the Promotion and Development Atal Pension Yojana. He is otherwise known as the APY man in our country. So the statistics and the numbers that you read in the paper, I don't have to say. More than 3 crores Atal Pension Yojana subscribers. That's his. He is anchoring and driving that initiative at the national level. He has got more than 20 years of service, of which about more than 10 years in PFRDA, that is Pension Fund Regulatory Development Authority, and it is supervising capacity of the central government, state governments, corporates, and many others. It's wonderful having with us Ashish Kumarji with us this morning, sir. And it's a privilege, and it will be, I know the participants will greatly benefit from your interaction today, and some key takeaways will definitely have. And for the participants, if you want Ashish Kumarji, the CGM, to take few questions, you kindly use the chat bot, then I will take, provided the time is permitting. We will see. Otherwise, all the questions, of course, we will respond at appropriate time. But some of the questions will definitely pose Ashish Kumarji to respond. Sir, the floor is yours now. We have participants direct login of more than 1,000. The YouTube viewers will be there mainstream. Plus, indirectly, many schools and college students are joining in their auditorium. So that's the audience you have today. It's a huge number, overwhelming response. Thank you once again, the audience, and it's a privilege for us to have you, Ashish Kumarji, with us this morning.
Thank you so much, Mr. Dwivedi, for giving me this opportunity to speak in today's webinar. So, first of all, I welcome all participants, and I've been told that mostly these participants belong to the school-going and college-going students. So, I welcome all these participants, and also I would like to congratulate NCFE for organizing this Global Money Week, right? So today's topic is planning smartly for retirement. So first, I have to establish one relevance, how this retirement is relevant to these college-going students, mostly because these school-going students and college-going students might be feeling that retirement is a quite far subject for them. So I will be covering that aspect in my today's speech. So first, we need to understand what is planning. So basically here, planning refers to financial planning. And I will cover first this part. And then afterwards, we'll be covering how we can do it smartly. So financial planning is basically for meeting out expenses for our major life events, and also for mitigating financial risk. So what are these major life events? We need to understand. And basically, this is planning for major expenses like purchase of any car, house, education of our kids, and also marriages of our kids. So these are major life events, and we need to invest. We need to save for these events, and we need to invest our money so that we can cover expenses of these major life events. And also, we need to make expenses on mitigating financial risks. So we need to plan for that also. And what are these risks? Basically, first we need to understand that first risk is risk of dying early. So for that, insurance we have, mostly life insurance we subscribe, so that we can mitigate this risk of dying early. So another financial risk is that risk of living more. So basically, for that we have pension products, we are having retirement products, and basically what is happening that life expectancy is increasing day by day. If we see a few decades back, this life expectancy was just 55 to 60 years. And currently, if we see, we find this life expectancy is around 50 to 75 years. And if we consider what would be in 2050, then we can say that it may be around 85 to 90 years. So life expectancy is increasing every year. And we know that this is just because of medical facilities. We are having better medical facilities. We are having better hygiene sense nowadays, better standard of living. So this life expectancy is increasing year on year basis. So if we consider that any person joins any job at the age of 25 years, so he's basically working for 35 years, while his retirement life would be around 30 years, 25 to 30 years. So more or less, this period are same, working life versus retirement life. So we need to save sufficient money during our working life so that we can meet out our expenses after retirement, after 60 years of age. So it is quite challenging, and we need to understand we can save this money, how we can save this money. We have to answer all these questions. So we need to buy some insurance policies, we need to buy some retirement products, so then we can mitigate these risks from our life. So basically, how we can do it? So now question comes, how smartly we can do it, right? So basically, we can do it by investing early. So that is the relevant point for today's participant, that these students are college going or school going, and very soon they will be attaining age of 18 years. So once they attain age of 18 years, definitely they can go for buying financial products like life insurance or pension products, right? So this is one of the way by this young generation should be encouraged to go for this life insurance as well as pension products. So for any investment also, we are having this power of compounding. So once this young generation, they invest for their future planning, like future events, like this purchase of any car, purchase of house, or for planning for their kids' education or kids' marriage. So they need to invest sufficient amount, and if they start early, definitely they will be getting two advantages. One is that they will be getting full advantage of power of compounding. So once they start early, they will be having higher corpus at the time of retirement or at the time of this life event, when they will be attaining that kind of age. And also they can invest in high risk investment also, like this stocks, we can say. equities, we can say that these are high risk investment. But if they are investing in younger, at the time of early age, they can definitely invest in equities. And by doing that, they can achieve higher rate of return, higher value of their investments during their investment life. And also they have to save high amount of money so that they can invest more, and that they can do by buying less of depreciating assets and buy more of appreciating assets. So we need to understand that what is depreciating assets and what is appreciating asset. So anybody, if he purchase any car, so that we can consider as a depreciating asset, because value of that car in next 10 years would be around 10% of its original price. While if this person purchase a share of that particular car company, so definitely after 10 years its value might be double or triple. So there they can understand that they need to make expenses on this appreciating asset, not on depreciating asset. And also they need to define how much they need to save for this investment for future life events, and also to mitigate risk of risk of dying early or risk of living more. So basically for retirement, it is said that we need to invest at least 20% of our total income, so that we can have similar kind of standard of living after retirement. So basically for these, PFRDA is having two schemes. One is National Pension System, NPS, for private sector, and also we are having Atal Pension Yojana. So basically for NPS, eligibility age is 18 to 70 years, while for APY it is 18 to 40 years. And NPS, it is open to all citizens of India, and it's a basically EEE product. It means that it is quite tax efficient, and it is a very low cost product, you can say. And currently we are having good number of around 1 crore 50 lakh subscriber under NPS, and its assets under management is also around 7 lakh crore. So it's a very good scheme. And also we are having Atal Pension Yojana. Atal Pension Yojana is basically administered by PFRDA, and it's a basically government of India scheme. And here eligibility age is 18 to 40 years, and anybody can join through this banks and post office under this scheme. And this scheme offers a guaranteed minimum pension of 1,000 to 5,000. So there are 5 slabs: 1,000, 2,000, 3,000, 4,000, and 5,000. And once this subscriber attains the age of 60 years, he will be getting that particular pension amount which he has chosen, right? And after his death, his spouse will be getting same pension amount till her life, right? And also, that is third benefit, is that once both subscriber and his spouse dies, then this total accumulated corpus will be transferred to their nominee. So basically this scheme is very good, because it is providing protection to all family, self, spouse, as well as children. So currently in this scheme we are having more than 3 crore 95 lakh enrollments, and we are quite sure that by 31st March we'll be having more than 4 crore enrollments under this scheme. And assets under management is also around 22,000 crore. And this scheme is quite successful in pan India. And when we see the customer mix of this scheme, what we find that younger population who are between 18 to 25 years, they constitute around 44% of total enrollments. So it's a very good thing. We can see that mostly younger population between 18 to 25, they are joining in a very good numbers. And it is just because contribution at this age group, it is quite less. as I said that once you start early, you get some advantage in investments as well as getting your life insurance and as well as in premiums. You'll be getting some advantage, because if you subscribe to life insurance, also premiums are quite less at younger age. And similarly, if you subscribe to Atal Pension Yojana, you need to pay very less amount of contribution once you join early. Also, we are having a very good thing that this is a women subscriber, they constitute around 44%. And we know that this life expectancy of our women subscriber, it is also 3 years higher than male counterparts. So they need more social security. So basically, I appeal all participants that they need to propagate this kind of information to all their near and dear ones, that women subscriber, they need this kind of social security because they live more. So we can subscribe to Atal Pension Yojana through banks and post offices. Also, online enrollments are also available, and people, they can enroll through net banking of their banks, and also they can join through eAPY portal offered by our Central Record Keeping Agency. And I think that this scheme will definitely create some awareness and sensitization, so that people can plan for retirement at the right time and at the right age. So I think I have covered most of the points, and now I am open for any question if participants have.
There are a few inquiries. Let me just. One from Debasmita Sengupta goes, although it is not absolutely related to pension, she would like to know, investment in land, will it help after retirement?
As a value, I think value creation would be there, no doubt. Once you purchase land and after 20-30 years, definitely we find that this investment has a appreciation, and we can put land in appreciating asset. But liquidity would be a challenge, because every day, every month, you can't get some amount for your after your retirement. So for liquidity and frequency of your need of money, that would be a concern.
So she also would like to know, although you have already covered that liquidity, safety, and the return, all these three things should be looked into for any investment option. So she's wanting to know, what is the best investment option that help after retirement? I think it should be the pension option that you would say, but anyway, you can respond.
So basically, we need to understand that how we treat any investment better. So basically, we need to understand that once your investment returns are higher than inflation, we can treat those kind of investments as a good investment. And definitely, what we understand that market-linked investments are quite good for retirement plan, because there you can invest. If you are starting early, definitely you can invest more on equities, which incidentally providing higher returns, so that your investment value would be higher once you retire.
There is a query from Dr. Ajay Singh. He would like to know, maybe a little more clarity will be required, but anyway, I'll try to rephrase that. What should be pension corpus after 30 years from now? Whether he would like to know the pension corpus, PFRDA corpus, or if he starts investing, what will be the corpus? Anyway, the question is, what should be pension corpus after 30 years from now?
So basically, I think it depends on various parameters. What is your current age? How much time you have before your retirement? How early you start? And what kind of risk in investment you can have? So you have to check your risk profile as well. So there are certain parameters, and one pension calculator is already available at our NPS Trust website. We are having this NPS Trust website. There you can put some value, how much time you are having for your retirement, how much you can invest, and currently what are your level of expenses. Based on these parameters, and once you put figures of these parameters, definitely will be getting that kind of information. But as a thumb rule, what we recommend that at least 20% of your income should go for retirement planning if you start early. Definitely, if you have already reached at the age of 50, 55, then definitely it would be quite challenging for you to go for appropriate retirement fund in a very short duration.
But there is one Soumyaranjan Mahapatra, he wants to know, but I don't think it's quite relevant here. But anyway, we'll try to respond that. Sir, can we believe on any online stock market app? But you can only talk about your APY app and tell them.
Basically, I think this kind of information is already available on Google. And at this forum, I think we should not answer this kind of questions.
Even that crypto thing also, we will skip it for the whether we'll invest, because here we are not giving any financial advice that where you should invest, which product and all. We are only trying to create awareness about financial literacy and various products and services. So whether we invest in crypto or not, it's individual choice. I don't think we should respond it in this platform. Maybe that's all now. Investment, what is the investment option? We took that.
So basically, I would like to
individual, all government, there is some question related to, for an individual investor, all government retirement schemes are not beating inflation. How to retire rich by investing in government? All government retirement schemes are not beating inflation. How to retire rich by investing in government schemes? Kindly suggest.
So basically, you need to invest in diversified kind of schemes so that you can get a good amount of returns, as well as different kind of investment things. You can invest in NPS, also in Atal Pension Yojana. You can also have some other products for your retirement needs.
Okay, so there is one Tejaswar HM. Under APY, after death of father and mother, the corpus will be given to nominee. Whether yes or no?
Yes, it is given to nominee. I told that APY has 3 benefits. One is that subscriber would be getting pension after 60 years till his life, until his life, and also once he dies, then definitely this pension will continue to his spouse. And once both subscriber and spouse dies, then definitely accumulated corpus will be handed over to this nominee.
So I think that's all we have time for now. Viraj, may I request you to propose a formal vote of thanks? Ashish, thank you so much for sparing your valuable time.
I just want to summarize my points once again, that these students are at younger age. So definitely they need to start investment early. They need to save sufficient amount so that they can invest in proper instrument, and they can have better life during accumulation phase, their working life as well as retired life.
Yeah, the best takeaway is that start investing early, adequate savings and appropriate investment.
Also, due to this, they can invest in some high risk investment portfolio like equities, and also they will be getting advantage of compounding, power of compounding.
Thank you. Thank you so much. Viraj, over to you, Viraj.
Yeah. Thank you, sir. Thank you, sir. First of all, it's an honor to offer today's vote of thanks at this special occasion. It was indeed a very interesting session. We all have received deep insight about planning smartly for retirement, especially Shri sir has emphasized on financial planning according to the life expectancy in the current scenario. Also, he has classified the various investment according to the risk profiles and giving us the benefits and the features of social security schemes like APY and NPS. All our participants were eagerly looking for it, and thank you, sir, for that. So on behalf of my entire team, I extend sincere thanks to respected Shri Ashish Kumar, sir, CGM, PFRDA, and Director NCFE, who despite of his busy schedule has kindly consented to grace this occasion and became a part of this event. We also convey our thanks to all our resource persons, financial literacy counselors, financial education trainers, school principals, teachers, and students who are connected with us through different means. And further, I would like to say that NCFE is conducting a national level online financial literacy quiz for Global Money Week for school students, especially for standard 6 to 12. So I would like to encourage all our participants and school students to attend this quiz, and there are prizes worth 1.5 lakhs to be claimed. So kindly give this quiz at its earliest because it will be available 27th. And also, I would like to thank all the participants for once again being with us at huge numbers, and hope we get the same participation on our fourth and last event, that is on Saturday. So thank you once again to Ashish Kumar sir and all our participants for being with us. It was a pleasure hosting such a beautiful event. Have a great day. Thank you.
Thank you. Thank you all.